That's right, the United States government is officially shut down. As of October 1st, 2025, a bitter stalemate in Congress has brought non-essential services to a screeching halt, putting hundreds of thousands of federal workers on furlough. This isn't the first time this has happened, and not by a long shot. In fact, we've seen this 22 times since 1976. During the last big one, the 35-day standoff in 2018-2019, the economy took a hit of an estimated $11 billion. And yet, the S&P 500 stock index actually went up over 10% during that exact same time. So, what does history really tell us about what's likely to happen to your money, your investments, and the market? And with today's volatile economy, should we expect something different this time? Let's get into the political blame game. See what history says about your portfolio and break down the real-world impacts you need to know about. Section 1. What is a shutdown and why is it happening? So, what exactly is a government shutdown? It's what happens when Congress can't agree on and pass the budget bills needed to fund the government. Think of it like a household that can't agree on a budget. Eventually, you have to stop spending on anything that isn't absolutely essential. The U.S. Constitution, along with a law called the Anti-Deficiency Act, literally prevents federal agencies from spending money that Congress hasn't given them. When that funding expires, as it did on October 1st, they have to shut down all non-essential operations. This means programs funded annually, what's known as discretionary spending, are the first to get hit. That includes a huge range of services, from the staff at our national parks to scientists doing research at the National Institutes of Health. On the other hand, mandatory spending programs like Social Security, Medicare, and Medicaid will keep sending out checks because their funding isn't part of this yearly debate. Services critical for public safety, like air traffic control, law enforcement, and the military, also keep running. But here's the catch. The employees in those jobs are often forced to work without pay until the government reopens. So why now? The 2025 shutdown is all about intense partisan gridlock over a few key issues. The two parties are in a standoff over federal spending levels for the new fiscal year. It's proposed cuts to foreign aid. And the big one, extending health insurance subsidies under the Affordable Care Act. The politics are messy, but it all comes down to a need for cooperation. Right now, there isn't any. With the Democrat-led White House and Senate clashing with the Republican-controlled House, passing a temporary funding bill has proven impossible. As you would guess, both sides are pointing fingers. Republicans accuse Democrats of holding the government hostage over policy demands, while Democrats argue Republicans are refusing to find a reasonable compromise. And while the politicians argue, hundreds of thousands of federal workers are left in limbo. Section 2. We've been here before. What history says about your investments with Washington at a standstill? The question on everyone's mind is, what's going to happen to the stock market? To figure that out, we have to look at the past, because this political drama is nothing new. Since 1976, we've had over 20 government shutdowns, though only a handful lasted more than a few days. And when you look at the data, a clear pattern shows up. The stock market is surprisingly tough. Historically, markets tend to view shutdowns as short-term political noise rather than a real threat to the economy. In fact, during past shutdowns, the S&P 500 was positive about half the time, with an average return that was basically flat. Let's look at a couple of the most dramatic examples. Remember the 2013 shutdown? It lasted 16 days over a fight about the Affordable Care Act, and the S&P 500 actually rose 3.1%. Investors seemed to just shrug it off and focus on the bigger economic picture. But the most telling example is the longest shutdown in U.S. history, the 35-day standoff from December 2018 to January 2019. That one was triggered by a fight over border wall funding. During those 5 weeks, did the S&P 500 crash? Nope, it soared over 10%. Now, that rally wasn't because of the shutdown. It was mostly driven by the Federal Reserve signaling it would be more flexible with interest rates. This shows that Wall Street pays a lot more attention to corporate earnings, economic trends. And Fed policy, then to temporary gridlock in DC even after shutdowns end. The market's performance is encouraging. 1 year after the government reopens, the S&P 500 has been higher 86% of the time, with an average return of almost 13%. While past performance never guarantees future results, history strongly suggests that shutdowns aren't a reason for long-term investors to hit the panic button. They might cause some choppy waters for a few days, but the market usually sees past the noise. Section 3. The real-world impact on your money and the economy if the stock market just shrugs off shutdowns. Does that mean they're no big deal? Not at all. While your 401k might be safe from the immediate chaos, the real-world economic pain is serious and can directly affect millions of Americans. The first and biggest hit is to the federal workforce. In this shutdown, an estimated 900,000 federal employees are furloughed, meaning they're sent home from their jobs without pay. Another 700,000 workers are considered essential and have to show up to work, but they won't get a paycheck until the shutdown is over either. A 2019 law does guarantee they'll get back pay once the government reopens, but that doesn't help with the mortgage, groceries, or daycare bills that are due right now. This puts a massive financial strain on more than 1.5 million households across the country. And remember, about 80% of federal employees work outside the Washington, D.C. area. So this is a problem that hurts communities in all 50 states. When all those people suddenly stop getting paid, they also stop spending. That creates a ripple effect that hurts small businesses, restaurants, and local shops that depend on those paychecks. The Congressional Budget Office estimated the 35-day shutdown in 2018-2019 permanently erased $3 billion from the economy. Beyond paychecks, a shutdown stops a ton of government services. The FDA might have to delay food safety inspections. The Small Business Administration stops processing new loan applications. Even the release of key economic data that investors and the Federal Reserve rely on, like the monthly jobs report, gets delayed, which just creates more uncertainty. National parks can close, hitting local tourism hard. And while benefits like veterans' healthcare continue, other support programs for things like job training and education can be thrown into chaos. If this breakdown is helping you cut through the headlines and understand what this all means for your money, do me a favor and hit that like button and subscribe to the channel. We work to bring you the data and analysis you need without the noise, and every subscription helps us keep going. Section 4. The path forward and what you should do now. So, where do we go from here? And what, if anything, should you do with your money? First, let's get one thing straight. A government shutdown is not a debt default. They are two completely different things. A shutdown is a temporary stop in government spending. A debt default, where the government fails to pay its bills like interest on U.S. Treasury bonds, would be a global financial catastrophe. A shutdown is a messy, disruptive political problem, but one that's historically been manageable. For the average investor, the biggest lesson from history is to stay disciplined. Market experts almost always advise against making knee-jerk decisions based on shutdown headlines. The data shows these events tend to be short, and the market's focus always returns to the fundamentals: corporate profits, consumer spending, and inflation. Trying to time the market by selling out and jumping back in is a tough game that usually ends badly. The most important thing to watch is how long the shutdown lasts. A few days or even a couple of weeks is unlikely to do major economic damage. But a stalemate that drags on for a month or more is a whole different ballgame. The longer it goes, the more the economic pain from lost wages and frozen government activity can build up, which could shake consumer and business confidence. A shutdown that lasts for weeks can lead to billions of dollars in lost economic growth. For most people, the best plan is to focus on what you can actually control: your long-term financial strategy. Panicking and selling into a volatile market driven by politics has proven to be a losing move time and time again. The market has shown again and again that it can look past the temporary dysfunction in Washington. So let's recap. The U.S. government is shut down because of a political fight in Congress over spending and healthcare policy. This has sent hundreds of thousands of federal workers home without pay and paused many government services, creating real financial hardship for families and communities. But when it comes to the stock market, history teaches a clear lesson. Shutdowns are usually temporary storms that markets are pretty good at riding out. The real drivers of your portfolio's long-term growth have always been economic fundamentals, not political theatrics. As the blame game rages on in Washington, the real test will be how long the gridlock lasts. We'll be watching closely. But for now, the historical data suggests that when it comes to your investments, the wisest move might just be to make no move at all. What are your thoughts on the shutdown? Are you concerned about its impact? Let me know in the comments below. And don't forget to subscribe for more deep dives into the financial news that really matters.